This is your Wall Street wake-up call. Oil prices falling despite a staggering 14.5 million barrel drop in crude inventories. Jasper Lawler joins me now. He's a market strategist with CMC Markets in London to talk more about this. So, Jasper, it's hard to please investors. We had such a dramatic decline in U.S. oil inventory. Good for everyone worried about too much supply out there. And oil rose on the news yesterday, but today it's down. People now think the report was an outlier. What do you say?
Hi, Scott. Well, yes. I mean, it was a massive draw in inventories, obviously the biggest since 1990. So you're going to see a big reaction in the crude price higher to that. But I think when you delve deeper into it, you see that it was Storm Hameen and its impact on the imports of oil from Nigeria and Saudi Arabia and other Middle Eastern nations that impacted those imports because they couldn't get through the storm. And also US production was lower. So just naturally, the effect of that is going to be a big draw in inventories. But if it is weather related, that would suggest it's short term. It may affect the coming weeks as a kind of trickle on effect, but it's not a long-term issue for the oil price. And so I think then again, markets today, they saw Brent crude hit that $50 per barrel mark. That's a big psychological level, and focus is shifting again back to OPEC and its meeting this month.
And then, of course, we have supply coming online from Nigeria, Iran, even Iraq. So, many analysts are now starting to question whether the market will come into supply and demand balance by the end of the year, which was a forecast they once had.
That's exactly it. Production in the Middle East just continues to ramp up and up. We're looking at some point in the future, perhaps at the meeting this month, but unlikely, that there's going to be some sort of agreement to freeze production. But that's still freezing production at record levels for most of these nations. So certainly the decrease in supply is not going to come from OPEC. The US production is proving increasingly resilient to the downturn in prices, and global growth is still pretty unsteady. So none of this really justifies the sharp move higher in oil prices that we saw yesterday. Maybe not enough to cause a massive drop down to new lows, but certainly not the kind of rocket higher prices that we saw in the last 24 hours.
Well, and OPEC is producing something like 33.7 million barrels of oil a day. So it's hard to believe that a production freeze will do anything. Now, let's just briefly talk about the impact oil will have on the markets. We know sort of towards the beginning of the year, oil and stocks were moving in lockstep. That correlation started to break down over the summer, but now it's sort of coming back online. What should we expect the market reaction to be from all this?
Well, what's notable is that stock markets pretty much moved in the opposite direction to the oil price, which is not the correlation that we've seen for a large part of this year when we saw this big drawdown in inventories. Obviously, it was a very specific issue to the oil market. It didn't necessarily pertain to global growth, which is sometimes the reason why stock markets move in sync with oil prices. And so the two diverged. And so my thinking is that actually with a bit less corporate and economic data, today the prices can move a bit more in sync. We're seeing that already with stock prices heading a bit lower, oil prices heading lower. I think that correlation can come back online. But nonetheless, I think it needs to be that economic global growth type demand trigger for oil prices moving higher that will move in sync with equities moving higher.
Yeah, and we're certainly seeing that correlation this morning. All right, Jasper Lawler, a market analyst with CMC in London. Jasper, thanks as always for your time.
Thank you, Scott.
I'm Scott Gam, and you're watching The Street.